So, hello everyone. My name is Vikas Agarwal, and I'm the founder of AIF and PMS Experts India. So, first, we would like to thank all the participants who have joined in today. With me, I have Mr. Anirudh Sarkar. So, it's a very special show again. Anirudh is the Chief Investment Officer at Quest Investment Advisors. He brings about more than 15 years of experience, out of which he has worked with IFL for almost 11 years as a portfolio manager. And he managed IFL Multicap PMS, which was one of the best performing PMSs by then, and won a couple of awards as well in terms of delivering the highest possible deliverables in the hand of investors. So currently now he's heading the investment team at Plus, as a chief investment officer, and ever since he has taken over, things are shaping up well because he's one of the areas of expertise is to identify themes at an early stage of their growth curve before they really take off well and ride through those growth journey, which is equally important. So what we thought is today, it's a very different time, volatile time. We saw what happened last week, and I'm sure all of you are curious to know where are we headed, both as an economy and as a stock market. So we thought we'll take the opportunity of inviting Mr. Sarkar today. Can you hear me?
Yeah.
Okay, so welcome on the show of Ask the Expert, Anirudh. As you know that at the first we keep organizing these sort of knowledge-based sessions, and last time we recorded one session with you. So, firstly, thank you so much for accepting our request and taking the time from your busy schedule and joining me today.
It's always, I would say, it's always exciting to interact with investors and participants like you, because it also gives us a different perspective of what the other side thinks about.
Sure. All right. Yeah. Sorry, you were saying something.
No, I'm saying it's always good to interact with investors and participants like you. So I think I'm more than happy to engage with you and your investors in this particular interaction.
All right. Thank you. So yeah, I can see that good number of investors have joined in now. So we can start the session. These are different times, Anirudh. And what I would request is one. A lot of people have requested me that since you're joining in, so why don't we start with outlook of equity market, which is generally a session which is followed by the main core theme. But this time I would request if you could throw some more lights on where are we headed, and then we would like to know about your funds and how do you manage and what investment philosophy followed at Quest Investment Advisors. Over to you.
Sure. So thanks for having me here and having me to interact with your investors. So I think the first thing which I'll try to touch base upon is as you mentioned rightly that investors right now, I think whether it is a small investor or it's a large investor, I think practically everyone is going through that whole phase of confusion, which is that where are we headed. And I think this is because if you look at our topic of discussion today, when the macros overshadow the micros, I think this is very apt. In this small image, I've tried to show that, basically whatever swings in the market we see, whether it's, the ups or the downs in the market, which we call the bull market or the bear market, I think it's basically a play between the macro and the micro fundamentals, which gets reflected in the investor emotions and sentiments. And ultimately, that is where we call the fear and the greed, which is, what is basically an outcome of these things happening. What we are seeing right now, I would say, is extreme fear. And also it is kind of, very evident that, you have multiple things at play. So if I just, and I'm just put down these points because in fact, the most recent investor letter also, which I sent out to my investors, in that I tried to capture these questions, which is kind of, haunting investors right now. So let's look at each of these aspects and, then see that, where does things stand? Because, typically in the market, there are two parts which move the market. One is events and one is earnings. And we'll come to the earnings part subsequently, but we'll talk about the events because, that is something which is overshadowing all our, investment rationals. The first and foremost is, the Russian conflict. And I think, that is something which has come out of the blue. It was not in the making, and it was not in kind of anyone's expectations a couple of months back that we'll come to this stage that Russia will invade Ukraine. So I think the typical thought process or the fear which comes is that have we already entered the next world war, and can this escalate into a major kind of a global military conflict? If I look at the last 10-15 days of this conflict, I think it's pretty evident that it will not escalate into a major military war. And that can be seen from the fact that neither US nor the NATO countries want to send any of their troops to help Ukraine. They are all being at the backside, saying to Ukraine that, we are there, we'll put all economic sanctions, etc., on Russia. But we don't want to send any troops or any of our military equipments into Ukraine to help you. So I think that is a very, very clear sign that they don't want any military conflict with Russia. And having said that, I would say that where both Ukraine and Russia stand today, I think it's a matter of time, whether a week or 2 weeks or 10-15 days, or maybe by end of this month, will definitely come to a solution. Either it will be Russia will be making its aggressive stance all the more aggressive and will venture all in and capture Ukraine, or it will come to the negotiation table with some, I would say, they have to give something to take something. So there will be some negotiations happening. And finally, I think this is going to see an end to it, maybe in a month's time or so. So that is addressing the major elephant in the room, that I don't see this conflict beyond a certain period of time. And if you go back in the history, I think every war comes to an end. It could end in 15 days, 30 days, 60 days, but it comes to an end. The second biggest worry, which is kind of on top of everyone's mind, is that inflation. And inflation is again something which is being talked about not just in India, but I think in the rest of the world. And definitely, it has its the repercussions on earnings. It has its repercussions on the household savings, etc. And on top of that, when you have the oil prices shooting over the roof and the commodity prices shooting over the roof, the fear is that will inflation kill the economic growth, which was expected to pick up post the pandemic. Now, inflation, if you look at where inflation is coming from, it is more of a supply side inflation, and it's not a demand led inflation. And that is where I have been of the view that this inflation cannot be tamed by increasing the interest rates, because a supply side inflation which has been caused because of supply chain constraints, the logistics issues, sanctions on exporting countries, etc., has led to your commodity prices shooting up. And this has nothing to do with the demand going up overnight. So hence, raising the interest rates will not be the right answer to getting inflation down. Once these conflicts get over, obviously the oil cannot sustain at 130, $140. It has to come below 100. Similarly, the commodity prices, they cannot sustain where it is right now. When we talk to some companies, the sense we get that there is no buyer of these commodities at these prices. And there's a very excellent line that it's only the high prices which kills the high prices, which means that since the prices are so high, nobody will buy it. And that's the reason the prices will come down. So, for example, if you see in India also, the oil marketing companies, people are expecting that just after the elections are over, on 7th of March, you'll find the oil prices going up. But it has not gone up because our oil marketing companies have almost like 36 to 40 days of inventory. So they also don't plan to buy at these levels. So eventually, the prices will cool off. So that's the reason I believe that, this inflation is also something which will come off from where we stand as of now to much more comfortable levels. The third fear which investors have right now is about interest rates going up in the US. And I think this is not something which is a new shock. I think for the last 1 year, the US Fed has been talking about the interest rates, which is likely to go up by March 2022. Just a month back, they were talking about a 50 bips hike. Now, all of a sudden, because of the geopolitical events, that 50 bips is now expected to be around 25 bips. And if you ask me to be honest, I think the Fed is also likely to go increase the rates by 25 bits, which will be more like a symbolic raise and not something which they really intend to do. So I think that the interest rates going up in the US by 25 bips or 50 bips over the next one quarter is not a very, very big event for the emerging markets outflow, because countries in the emerging markets have been seeing the outflows for the last 1 year. So it's not something that, post the raise, the outflow will be more. Uh, Now that again, brings many people to think that will RBI also increase rates in India? And this is one debate. Many HNI investors keep asking that, will RBI also increase rates in India? I have been of the strong view that I don't see interest rates going up in India in the next 1 quarter at least. Could be sometime in the second half of the financial year, but not in at least the first half. Because if I go by all the commentary and the views of the government and RBI, I think the focus is more on pushing for growth. And when you're pushing for growth, you do not want your interest rates to go up. And in that type of an environment, there is no reason that interest rates will go up in India. And I think when you talk to banks have been saying that borrowing is not happening. So when banks are complaining of borrowing, I don't think so. Your inflation can be tamed by increasing the interest rates. At the same time, when the government is also pushing for ownership of homes, capex cycle, I think the very objective of keeping interest rate low to drive capex cycle, to drive the home ownership, is something which goes counterintuitive if one looks at, tells RBI to increase the rates. So we don't see the rates going up in India. And the last of it, what fear people had over the last 15 days is what if BJP loses in the UP elections? And I think BJP has done much, much better compared to what many of the political analysts were expecting, not just in UP, but I think in the other states also where, it has come back in power. So I think overall, if you look at this slide, it is giving you an impression that the fears which have been there, or the macros which were kind of, overshadowing the investor decisions, these are all some things which will come to an end, whether it's a war, whether it's the election outcome, Fed policy meet which will happen over the weekend. So that always brings me to the point that it's a time to start looking at the micros, and that is where I've been focusing investors over the last 10-15 days, that look at the earnings, because that is where I'm getting a lot of comfort. So if I see where FY23 or FY24 earnings are going to be, it gives me a lot of comfort that we are very, very attractively priced based on FY24 numbers. So if I talk about the Nifty earnings on FY23, it is expected to be around 885 to 900 rupees. And FY24, the Nifty EPS is expected to be around 1000 rupees plus minus. Now, if I look at FY24 at 1000 rupees EPS, and if you talk about Nifty sitting at say 16,400, you're actually talking about a 16.4p. Now, based on the next 2 years numbers at 16p, I don't think so market is expensive. And at the same time, if I talk about the earnings growth, which can happen in the next 2 years, I think before the conflict, the street was expecting around 17 to 18% earnings growth. If I take some margin contraction, some EBITDA margins impact, etc., I think this earnings growth will come down to around 14 to 15% or 15 to 16%. Now, with a 15-16% earnings growth over the next 2 years, and with a market P of around 16.4, I don't see a reason why I should say that equity markets in India are expensive. So it's not that when I'm saying that investors should be looking at deploying additional funds in the market at this point of time, and investors should not exit equities but rather hold, or if there's additional liquidity, one should put in more money. It's not without any base. The very base is that markets are not expensive, earnings are going to grow at 15-16%. I'll also talk about, I'll focus on the sectors where I see the earnings are going to be the most important. And with the 15-16% earnings growth, market sitting at a 16p, I don't see a reason why one should not be looking at mid-teens to high-teen types of returns over the next couple of years from the equity markets in India. Now, if you remember, one core strategy which we have always in our portfolio strategy is the sector rotation strategy. And that basically goes around the philosophy that different sectors go through earning cycle, different sectors perform differently in the different market cycles, and the idea is that you need to be in the right sector at the right time.
Yeah, I was coming to
So
that, Aniruddha. In fact, I wanted to ask you this question is, you are always ahead of the curve in terms of identifying those themes. So if you could talk to us that how do you manage to identify them at an early stage of their growth curve or the change,
sure,
and then talk about the sectors. So over to you.
absolutely. So if I go back and see, in the last so many bull runs we have seen in the market, I think, it's pretty evident that, in each bull run or maybe in the each market rally, it is not always that, everything has moved. There are sectors which really do well and there are sectors which really underperform. So that has been, I would say my core strategy, which is focusing on the sectors where the valuation is on your side, earnings growth is going to be the highest, and also the risk reward is in favor, and where you have enough visibility with regard to execution of projects, execution of orders, or maybe earnings growing faster than maybe double the industry growth rate. So if I see the last 4 5 bull runs, like 99 2000, we are all aware that how IT as a sector, it outperformed the old economic companies. As you can see, your Infosys, Wipro outperforming your SBI and BHELs of the world. Coming forward to the 2006 to 2008 rally, you'll see how the capital goods. So it just went around. Capital goods which did not do well earlier, capital goods outperformed your defensive sectors, and you had companies in the real estate infra sector outperforming the defensives like HUL, like hands down. Coming forward to the pre-pandemic rally, we saw that the growth-oriented consumer stocks, they were outperforming the cyclicals, and that if you remember the time from 2018 19, the growth-oriented companies, they were outperforming hands down your Asian Paints, Pidilite, HULs of the world, and you had the cyclicals like your metal stocks, the real estate stocks, which are heavily underperforming. Post-pandemic things again turned around. You had the cyclicals outperforming hands down compared to the defensives, like your HULs of the world. Now, this always, this comparison, why I try to show is that this actually gives you an impression that though we might all be saying that we are long-term investors, but it's very important to identify that every sector, whether it is an FMCG, consumer, metals, real estate, banking, IT, cap goods, infra, everything goes through a cycle, and it is very important that not just when to be in a sector but also when to be out of a sector, because if you're able to be out of a sector when the cycle is on a downturn and allocate that money to the right sector with a higher allocation, that is where your big alpha creation will happen. And if I look at my portfolio construct over the last 7 years of managing the PMS, I think at any point of time you'll find that the top 4 5 sectors make up 80% of the portfolio, and these sector allocations are very very agnostic to the benchmark sectoral allocations, which means that there is no focus that if a particular sector is very high on the benchmark, I need to have a similar allocation in my portfolio. uh, Now comes the more important point that what do we see in a sector, and where do we see the next pockets of opportunity. And also this I'll explain the sectors by showing that what are the things which we are seeing in the sectors, which will give you an idea that how do we identify these sectors. The first and foremost sector, which if you remember, almost like 14, 15 months back, we had gone overweight on the real estate and home improvement sector. Now, when I go back in the period from September, October, November 2020, when we had gone overweight on the real estate sector, it was a sector which was against, I would say against the market consensus, which is like, there were very few people on the street who wanted to talk about the real estate sector. But in fact, now on hindsight, many people ask me that, how were you able to identify this sector will do well? So these were some of the indicators, like, when we do our checks on the ground about interacting with, the business channels, interacting with the distribution channels, interacting with managements of the companies, we got a sense that, the transaction was coming back in the sector. The end users who were sitting on the edge of, either to rent or to buy, they were getting into that phase wherein they were turning into the buyers. Now that was because affordability had improved after almost 8 10 years, which gives you a sense that if you look at the prices of the properties, they have practically remained flat for most part of the last 7 8 years. On the contrary, the income growth has been there in the economy over the last 7 to 8 years. And along with that, the low interest rate, which was there in the economy, that was kind of the lowest rate we have seen ever in our life. Now, these things were making the affordability of the homes very, very attractive, wherein, the prices have remained flat for the last 7, 8 years. You have seen a decent amount of income growth, and along with that, your interest rates are at the lowest. So these three things make the affordability of the homes as very, very attractive. So that gave us the first kind of an itch that we need to look at the sector. When we spoke to the builders, we saw that the pattern of buyers is very different compared to the earlier. Wherein the earlier cycle of 2007 to 2011, most of the buyers were the investors. This time around, most of the buyers were the end users. And that gives you a lot of comfort because these end users are the people who are going to actually occupy the house. And they are the ones who are going to spend a decent amount on doing up the interiors. So that's why, along with the real estate, we also went overweight on the home improvement. Another thing which we had observed over the last 4 or 5 years is the consolidation in the industry, in which we saw a large number of unorganized players going out of business, which means many of the small builders and players who were there in the business, they were forced to go out of business because of the liquidity crunch, because of sales not happening, and the larger established brand names became bigger and bigger. And that is something which again gives you a lot of comfort that now post the implementation of the policy from the government, you had executions happening in the sector, you had financial the closures happening, there was no delay in the projects, which was always an issue earlier. Projects used to get launched and not get delivered for 10 years. So all these things were getting addressed, and these were the things which gave us a confidence that this is a sectoral rally which is going to be there for a very, very long time. Along with that, another indicator which was there, which kind of gave us an indication that I'm talking about these indicators just to give a sense of what are the things we look at to arrive at a sector call. The other thing which we were seeing in the sector is that the number of the new launches happening in the real estate sector was significantly lower than in the past. Now that leads to your inventories getting exhausted. As unsold inventory gets exhausted in the sector and the new launches don't happen as much as it was happening in the past, that leads to some stability in the prices also. Because earlier when there were a number of unsold inventories are very, very high, there were a large number of distressed sales used to happen, and that used to erode the price. So those things were not happening, and demand had come back. If I talk about the demand, which is the most important, for the last 4, 5, 6 quarters, demand has been extremely, extremely strong. And that you can again attribute to the fact that both the IT sector and the non-IT urban working class, they have seen their income levels going up. So it was a multitude of all these factors, which gave us the confidence that the real estate sector is here to stay. And in fact, even now when I speak to some clients, investors ask me that is the sectoral upside over and done? I believe we are not even in the middle of the real estate sector rally, and I think this sectoral rally is going to be there for the next couple of years. And this is going to be from the fact that ownership of homes is still very low in the urban, and also income levels are continuing to remain very strong. And I think this is a sectoral trend which will continue to do well. And also along with the real estate, ancillaries to the real estate, which is your home improvement companies like electric wires and cables, appliances, the tiles, bathroom fittings, etc., which will continue to do very, very well. The second sector where we believe that the sectoral uptrend will continue as of now is the banks and financials. Now, if you remember, one sector is banks, which we have been mostly underweight for most part of the pandemic. If I talk about the last 2 years, in the last 2 years, almost 18 months, the first 18 months, we have been heavily underweight on the banks and financials. And this was for the reason that because of the pandemic, we found that there were concerns with regard to NPA recovery from the retail side. There were concerns with regard to the loan growth happening. And at the same time, the RBI regulation about, extending of the moratorium. These were things which was definitely not a very, very comfortable things for the banks and the financials. Also, past, so before pandemic, the whole NPA cycle which was seen in corporate banks like SBI, ICICI, Axis, those had made the valuations of these banks very, very attractive. And I would say the pandemic was like the final nail on the coffin, wherein the valuations had reached the trough. Now, with those things in mind, we started picking up many of these financials. And if I see where we stand today, I think, banks like ICS and SBI, which remain our overweight portfolio allocations within the banking and financial, if you look at their ROE profile, they have drastically improved over the last couple of years from where they stood, say, in the bottom of March 18 or even March 19, wherein that, because of the NPA cycle, their ROEs were like, in single digits, or for case of SBI, it was even in the negative. From those levels, the ROEs have come at levels which are comparable to your HDFCs and Kotaks of the world. Now, where your ROE profiles are comparable, but your valuations are a fraction, that becomes a very, very compelling reason why to go overweight on those banks. And that's the reason, we have a larger allocation in our portfolio to corporate banks like ICICI and SBI. And in fact, I would say that I'm sure you are much more aware, SBI being one of our top holdings in our portfolio, very few PMS managers will venture out into an SBI being one of the top holdings in their portfolio. So our view was that banks like SBI and ICICI were in the past the most, I would say, affected because of the NPA cycle. They had the highest NPA provisions. And now with NPA resolutions happening with NCLT and the IBC, with the money coming back into the economy and to the system, banking system, these are the guys who will get the biggest chunk of the recovery. And these are the guys who will get the biggest capital inflow, if I have to say. And that is exactly what we are seeing with big cases like Bhushan Steel, Diwan Housing, Air India, etc. All these cases coming out. Banks like SBI, ICICI are going to be the biggest beneficiaries of these capital flows which are happening back. So we believe that banks and financials definitely are going to continue to do well. And thanks to the last, I would say, 4 or 5 months of the sharp correction we have seen in the banking stocks because of the FI outflows, because FIs typically hold very large allocations to banks. And with their outflows happening, it has made the banking stocks very, very, very attractive. Wherein that, many of them are now quoting at the similar valuations where they were almost a year back. Now, that is something which gives us a lot of comfort that, with the banking index, which typically, if you look at historical, this bottom chart, if you see, bank index has typically outperformed Nifty. But for the last couple of years, we are seeing how bank index has heavily underperformed Nifty. If I just talk about the mean reversion from where we are right now, I think, we are looking at a picture wherein banks as a sector, banking and financial as a sector will definitely outperform the broader market. We can say to some extent that because of inflation or because of growth being a bit low, we might not see that type of a recovery. But even then, in that perspective, on a relative basis, we expect that they will outperform the broader market. The third sector where we are currently very bullish on is the whole auto and auto ancillary space. And this is again something which we believe is a good opportunity both on the domestic side as well as on the export opportunity. With the whole migration to the EV, shortage of semiconductors which is there, and along with the government PLI scheme, I think these three are I would say, the right ingredients wherein I see a lot of opportunity in the auto and auto ancillary space. The reason for that is that, with the shortage of the chips, most of the companies are running on a backlog of 6 to 7 months. So that gives you a visibility that for the next 8, 9, 10, 12 months, there's enough order book for execution. And as the shortage of chips is decreasing as we speak, I think, you will find most of these plants running at full capacity, which will get reflected in the earnings. We can have one debate on that, saying that because of the rise in commodity prices, you will find some impact in the margins for the auto companies, which was expected to recover. But I think that is something which will get sorted out in a quarter or so. If I'm talking about a slightly longer term horizon from 4 to 6 quarters, I think the margin impact from the rising input cost is something which will get passed on eventually. And in fact, that was one channel check which we did, is that our prices being passed on. And if you look at Maruti, if you look at Tata Motors, both of them have been taking price hikes continuously. And when we spoke to some of the wholesale dealers that, has the orders cancelled because of price hike. So I would say the similar answer we got from all of them, that, there is no cancellation of orders, because people who have been buying these cars, the new models and all, they are not bothered if you charge them 20,000, 30,000 rupees extra. So there has been no cancellations, because typically what you see, if you look at our exposure also, we are more exposed to the passenger vehicle side, and passenger vehicles are less elastic to demand on price hike compared to the bikes and the scooters, because the bikes and scooters are bought by the low income group, and that is where the income elasticity is higher, the demand elasticity is higher. So that is the segment which we are avoiding right now, because we don't want to venture out in the bikes and the scooter space, because you have too much of disruption from the EV makers also. But we are bullish on the four-wheeler space, passenger vehicle, and also on the commercial vehicle side, as demand is going to pick up after almost 6-7 years. The CV cycle is likely to pick up. The whole migration to EV is also something which is opening a lot of opportunity for many of the auto ancillary companies. And thanks to the PLI scheme also, which the government has come out with, I think, we are seeing India as a major export hub for many of the auto ancillary components. In fact, some of the portfolio companies which we have, in fact, one portfolio company which we have, which is Bosch. So the parent of Bosch is looking at making India Bosch unit as one of its export hub. And things like these gives us a lot of confidence that, MNC auto ancillary companies, which are kind of, in a very sweet spot, wherein the parent wants to make India export hub, government is giving you PLI schemes, and there is also enough kind of, unmet demand, and the whole EV migration is going to give you a lot of opportunities. So these are areas where I see that, if I look beyond the current set of events happening with a 2-year, 3-year, 4-year horizon, there's enough alpha creation which can be done in this space. The fourth sector remains my all-time favorite, which has been kind of my favorite for the last 15, 18 months, which is the IT and IT sector. And in all my interactions, I've been saying that, IT sector is going to be there for the next 12, 18 months, 24 months also, because that gives me the confidence I get is from the very fact, which is very, very simple, elaborated in this chart, which is basically trying to show what is going to be the IT expenditures happening over the next couple of years. So if I see, the whole IT software expenditures, you're looking at this IT services expenditure. Typically, it used to be around, 2 to 3% in that range. 2 to 3% was the typical IT services growth which was visible. And that's why, most companies in India, they should grow marginally higher than that. Around 4 to 5% was the growth of most Indian large IT companies. In the last 18 months, that growth has gone up from, 4-5% to anywhere like 14-15%. And I'm talking about the Indian IT companies. And internationally, if I look, that growth figure has gone up to around 10-11%, which might moderate to say around 8-9% for the next 36 months. Now, if you are talking about an international IT services growth of around 8-9% for the next 36 months, Indian companies can easily grow at around 14 to 15%, which is almost like 5-6% higher than the global IT services growth rate. And specific companies within the IT in India, like one of our portfolio companies like Tata Elxsi, they are looking at a growth of around 25% plus. Now, where on earth do you get a 25% earnings growth visibility for the next 24-36 months? So this is the type of, space I believe that, there is enough kind of growth opportunity which is happening in there. And now, if you ask me that, how we went overweight on the IT sector, now, when I go back, 15, 18 months back, and see what was the, outlook on the sector, when the pandemic had just begun, the first hypothesis was of the street that IT sector will be the worst hit sector, because, with travel coming to a stop, overseas travel coming to a stop, typically people associate IT employees as, going overseas for the client side. Now, when that was coming to a halt, you had the first thought was that IT projects will come to a halt. But when we interacted with some of the the companies, we got a sense that the whole migration towards the working from home is happening on a very, very different footing compared to other industries. And within a month or so, practically every employee was working at the same pace at what they were working earlier. Even the customers were very, very okay with the work getting done from home. Now, with that in mind, our view was that IT as a sector will be the biggest beneficiary of pandemic, because as world comes to a halt and everybody is working from home, businesses will have to migrate to the cloud. And companies in the the cloud migration, which are there, the larger US companies like Microsoft, Google, Amazon, etc., they all do projects with Indian companies, and the whole migration to the cloud is where the different the cloud technologies which Indian IT companies also specialize on. Those are things wherein you'll find a lot of growth opportunity. And the interesting part of the whole pandemic was that there were sectors and companies which have seen very, very less of IT implementation. And when we speak to some of the companies in the IT sector, they say that these are companies which have hardly come to us ever, and now they're talking to us about IT projects. So these are kind of sectors wherein historically they would not have ventured into the IT, and these were the new opportunities and the new deal wins which are happening for the sector. And if I look at the pipeline for the deals, even for the next 12 months, 15 months, I think is extremely, extremely strong. So that gives me a lot of comfort that IT as a sector is going to be there for the next 15, 18 months. And that is where will be kind of the fourth big exposure for us in our portfolio. Also, a good indicator is the number of employees you are hiring. And I think after a very long time, we have seen the number of the new hires happening in the whole IT sector, which is at kind of the record levels. Whether you're talking about the fresh hires from engineering colleges or the professionals who are already working, I think this is giving you a lot of comfort that with the type of salary increases the IT sector is seeing, I think this is kind of a sector which is going to be an overweight allocation in our portfolio.
In fact, some of them, just to add, not able to even hire. The number of people are so less in the industry, and it's a very skillful job, so we'll have to kind of offer job to freshers and inviting them to join. That's a situation.
Absolutely, absolutely. I think there's a big shortage also. Like there's a big shortage of the right skilled people, and there's a lot of attrition happening. In fact, I have not seen this level of attrition which is happening in the IT sector. So all this gives you a thing that there's enough demand of new projects, project executions, because earlier there was a concern that a lot of employees are sitting on the bench. Now with the type of projects, there's hardly anyone who's there on the bench. So these are again indicators that IT as a sector is going to be there for a pretty long time. The fifth and last sector where we are very bullish on is the chemicals, and we have been bullish on this space for the last 18, 24 months. And the major reason for that is that you're seeing a lot of value migration happening in India in the chemical sector, wherein earlier you used to only find the commodity chemicals companies doing well, which was to supply the bulk of the chemicals. But what we have seen in the last 24 months is that a lot of these companies have migrated up the value chain, and they are now doing more of the high-end chemicals manufacturing, which was typically done, say, in Europe or in other Asian countries. Now, that is a very big change for Indian chemical companies, which is moving up the value chain. And thanks to the whole China plus one thought process of international buyers, that with more and more conflict happening in Russia, China, I think the European customers and American customers, they are more now willing, or rather they have to look at an alternative. And the only country which has a decent I would say size and also companies working in that space is India. So growth wise, I have no concerns on the chemical sector, which if you look at this first table, you'll see consistently the sector has been growing at 20% plus. And this gives a lot of comfort that this growth is going to be there. And the other thing which gives me comfort in the sector is the capex plans in the sector. So the capex plans are very, very high, and I think that is where I would say that it gives you visibility over the next 36 months that chemicals as a sector is going to continue to give good returns. Valuation becomes always a concern because the chemical sector has seen a massive, massive P multiple expansion. Some of my portfolio companies, when we had entered, they were at 14, 15 P, which might be now trading at 25 to 30 P multiples. But I believe that I don't see a P multiple expansion happening there, but I see a continuation of earnings growth, which will get reflected in the price movement also. So I think this is the fifth sector, which is an overweight allocation in my portfolio. So these were the broad thought process around, what are the sectoral allocations where we like, and, what we want to kind of have an allocation, which goes in sync with our core strategy of sector rotation and focusing on sectors where we believe the earnings growth is going to be kind of higher than the broader market. An important point again in our portfolio is in a portfolio construct is about company rotation, and that is an extension of sector rotation, which is within the same sector. Like, if I spoke about, say, the real estate sector, for an example. Uh, Now, do I want to buy a DLF or a Prestige or a Shobha, etc.? That will again depend on the valuation. Like, say, for example, I might be having a DLF earlier, but valuation wise, maybe Prestige looks attractive now, or a Shobha looks attractive now. I don't mind moving from a DLF to a Prestige. So maintaining the same sectoral allocation, we will move between the companies within the same sector. We have done similar shifts within the auto space also in the past, wherein moving from a Maruti to a Tata Motors DVR, which has again given us like a 150%, 200% alpha in the switch itself. So these company rotations are also done, which is a part of our overall portfolio of philosophy. So these are the broad thoughts about the market and what we would like to kind of do in our portfolios. We'll be more than happy to have any questions from your end or from anyone.
Sure. So what we'll do is we'll open the forum for Q&A. So if any of the participant has any question, please feel free to ask. So my first question is Anirudh. So thank you so much for the detailed presentation. So as you rightly said that there are 3-4 sectors which look good, but what are the 2-3 sectors you think may not do well? One, because of the issues that the economies are undergoing at the moment, and two, the inflation which is really going to affect.
See, I think one sector which might have its pain is the whole FMCG consumer space. Now, that is a space because the concern is that, there the input costs are very high. So, the whole inflation part which I spoke about, that is something which is going to hurt the FMCG basket, the consumer basket. Now, you can ask me that, won't it affect the other sectors? Now, in the other sectors, as I spoke about auto, for an example, auto also falls into the consumption. But there, the possibility of the companies to pass on the price is much, much higher compared to, say, a Britannia or a Nestle, wherein they want to pass on the price hike to the consumers. It is very, very price sensitive. Now, say, for example, in the biscuits or maybe the low-end FMCG personal care products, even a 10% price hike is a very, very big price jump for the users of those components. So price hike of 10% might lead to a volume degrowth happening, because there the options are many. Like, if an HUL increases price and a Dabur or a Marico does not increase the price, you will find the shift of the customer happening over there. So as a whole, FMCG is one space I feel is not going to do very well in the next 6 to 12 months. The other space where I would not say I'm negative, but I would say I would want to wait for some more time to see action happening is the whole the infra space. The infra space is one space where I would want things to show more visibility of projects actually happening, because the input costs in, again, the infra space is something which will impact their project margins significantly over the next 6 months. With metal prices, cement prices, everything going above the roof, I think projects might get delayed over there, executions might get delayed, and that is something wherein I believe that we would still want to wait and watch before taking a call over there.
Okay, so next question comes from Badrish Kaur. As the COVID is not over yet, what are your views on pharma industry? Will it be considered under what sort of categories you're looking at?
I think practically, the war in Russia and Ukraine has finished COVID. because I think these days nobody talks about COVID. So apart from the jokes, I would say that I believe that COVID as such is behind us, and I think the last wave, which was the Omicron wave, that gave us the indication that most of the population, at least in India, is well vaccinated and well immunity. The immunity level is pretty high, and there are talks about the fourth wave starting in June, July, or something. So I would say that there is no fear from COVID as such now, and now with everything has opened up practically, and the schools was the last thing government had to open, and now I think they've opened up the schools also. So I think COVID is something which is not in the calculation, and any future waves which will happen, I think that we'll have to see how much is the intensity. Coming to the outlook on the pharma industry, I would say pharma as such we are bullish, and I would not relate the bullishness in the pharma to COVID or non-COVID. I would say overall pharma Indian companies are in a space right now wherein growth opportunity is very high, because many of the pharma companies have now done backward integration. Earlier they used to import from China and then do the processing and sell it overseas. Now, with many of the European and US customers wanting an alternative to China, the whole China plus one opportunity is also working in favor for the Indian pharma companies, wherein companies who have done good backward integration are becoming a good option for international customers to move their businesses from China to India.
The next question is, what's the deployment strategy at the moment? Like you're deploying 100%, or if somebody starts PMS, so you deploy over a period of 2 months, how is it?
As of now, we are deploying roughly between 70 to 80%. And for the new clients, we are keeping around 18 to 20% cash. And that cash level also over the next 1 month will get deployed. And it's not that I'm negative on the market. It's just that, with the type of swings happening in the market, you would want to time the market to some extent. Wherein that, with the type of swings happening in the market, you might get a better entry point over the next 1 month.
The next question is from Mr. Ritesh Singh. Tech businesses in India is growing continuously. So what are your views on tech-based businesses, irrespective of their loss-making nature? Good question.
I think he's talking about the new age businesses.
Yeah.
So basically the new age businesses which are there, honestly speaking, I have not been a very good fan of them as an investor, though I've been a customer of all those businesses. And that is something I would say is a big, big confusion that, I'm a customer of all of those businesses, whether it's a Zomato or it's a Policy Bazaar or it's a Nykaa, etc. But as an investor, I do not want to put my money there, because I think ultimately we need to see that where can I make my 15, 18%, 20% types of return in the medium to long run with the minimum risk. So that risk component is something which I don't get answer to in the new age businesses, because the issue is that, many of these businesses, their models are such that entry barriers are very low. Now, when your entry barriers are so low, there is enough kind of risk to the business. Now, if I take the example of Zomato for that matter, like, you can say that there's only one Zomato and a Swiggy in the market. But the way Zomato has been putting up money into different businesses, I do not get the comfort that how do I value the business? Like earlier when internally also, like I'll just share about Zomato, when we were evaluating the company during the IPO, we had done all the SOTP valuation of its different businesses, taken a growth rate of the number of users. If it goes up by this much percentage over the next 2-3 years, what can be kind of the top line, bottom line, etc. So those gave us some sense that, okay, this is a fair value at which I would be okay to look at it. Now, post the listing, company has done so many private equity investments. They have invested into 4-5 startups. Yesterday, there was a news that they are giving almost 80 to 100 million of the debt financing to one startup called Blinkit. Now, how do I value these businesses then? If it has become from a food ordering and the restaurant business to NBFC, which is giving the debt financing to startups and also putting some money into other startups, then it's very difficult. It's to evaluate that if any of the startups where they're putting money, it goes bust, it's a complete washout of that investment. On the other side, they can become 4-5x also. So there are very, very too many uncertainties. So I would typically stay away from these businesses as an investor. Only business which I like in that space is Policy Bazaar, because I think that is the one which has very low entry barriers, sorry, very high entry barriers, because in spite of all the insurance companies having their online presence, still you will find almost all of the insurance companies, they do a tie-up with him. Now, most recently, even LIC has done a tie-up with Policy Bazaar because of the type of reach and the database which they have. So that is one space where I believe that, which has a decent kind of business model. But then again, the question comes that, what is the right value, or what price you should buy. Very difficult to value again. But I would say in these businesses, it's okay to allocate a very, very small part of your overall portfolio. Even I would not put more than 5% into all the new age companies combined.
Next question is, what are the other factors to keep in mind apart from earnings when we think about micros?
See, when I talk about evaluating a company, earnings is not the first thing which we see. Like, when we talk about evaluating a new idea which comes to our table, in fact, the first thing which we talk about and which we discuss in our investment committee is about the management. And that is something which becomes the first filter. And when I say management, it is not just about management ethics. It is about the past track record of the management. So that is very important to see that, has the business been taken by the management through the different business cycles without major impact to its earnings, without major impact to its growth plans? Is the management's execution capability good enough? Because, many a times, many managements, they talk big things, but they're not able to execute. Has the management been able to execute and delivered much more than what they have promised? Also, it's very important to see that what is the past track record of the management in the previous companies, because many of these managements, they might have worked in previous companies, and you might not have a very long track record of that management in the current company, but he might have worked in a previous company, and how he has done over there, that gives you a good sense again that, how the management will do. Now, just to give an example, like the current the management of Tata Consumer, he was earlier in Whirlpool. So when he moved from Whirlpool to Tata Consumer, there was a P contraction in Whirlpool and a P expansion in Tata Consumer. Now that gives you the direct example of what I'm saying, that, why we take a bet on the management, because people bet that, okay, this guy will do well in the current place because he has done wonders in the earlier place. That is something which we take a bet on, and that is something which we will be evaluating first. Post this, we also see earnings is obviously one part. We also see what is the ROE profile, margin profile. Are these stable to improving? Are the margin profiles stable to improving? ROE is stable to improving. The leverage on the books. The leverage on the books is something one needs to keep an eye on. And when I say it needs to be kept an eye on, don't take me otherwise, but also look at companies with high leverage. It might sound very, very different to what many people say, that, avoid companies with high leverage. I sometimes say that do keep an eye on companies with high leverage, because typically companies which are in the cyclical part of the market, they are the ones which will have a high leverage at the bottom of the cycle. And when the cycle turns, huge cash flows come in, leverage comes off drastically, and then the market gives it a very, very different P multiple. In the last 24 months, we have seen that happening in the metals, we have seen that happening in the real estate, we have seen that happening in the power companies, we have seen that happening in many of the high levered auto companies. So keep an eye on the leverage, take a bet on the high levered businesses which are run by good management, but they were at the bottom of the cycle, and that is the time you'll find them at a good value. So when the cycle is on upturn, say for example a Tata Steel, a Tata Power, etc., these were businesses wherein management is excellent, but they were at the bottom of the cycle sitting with high leverage. When the cycle turned, huge cash flows are coming. Now, if I talk about Tata Steel, I think in the next 4 quarters, they'll go completely debt free. Now, from sitting at, enormous amount of debt to going debt free after, 10 quarters is something which is one needs to keep an eye on. And if you have caught it at the right time, you would have made exponential money in these businesses. So these are other things which we see apart from just looking at an earnings growth.
Yeah, I remember Tata Motors during the COVID time, it had gone to as low as less than 100 rupees. And I remember you picking up the stock
Yeah,
goes back.
yeah. So it was quoting at point 0.4 price to book. And if you get a industrial business at point 0.4 price to book without fear of the business going bankrupt, I think the downside looks very limited from that point of time.
Yeah, the other thing is, Anirudh, this is my question, personal question. So, from an FII point of view, historically they've made good money in India, and now that some of them have shown concern going to China and investing Chinese market. Now with so many things coming up on Russia, now they will have some reservation to invest their money over there. You think then India is the only place which is left out in terms of structured manner, that we can attract more monies because they have been net seller for over a period of last 1 year?
I think you put the question in the right frame that, in fact, if you look at the outflows from India, is not happening because FIs are negative on India. It is happening because of ETF redemptions from the emerging market basket. Now, typically in the ETF, the emerging market basket, you had different countries which were allocated. Within that, you had India, China, Russia, Brazil, Indonesia, Vietnam. So these were the countries which are allocated within the emerging markets. Now, within that, in the last 1 year, what you have seen is China has gone down heavily on the tech companies. Now, that has changed the perception of the FIs towards China. Last few weeks, with Russia issue happening, Russia has been removed from the MSCI emerging market basket. Now, these are the two big pieces which were there in the emerging market. Now, with that happening, FIs are looking at decreasing their allocations to these. Now, how do you decrease? You have to sell your emerging market ETF. Now, in that sell-off, India is also getting sold. Now, when you talk to FIs, when I talk to some of them, the sense I get is that, this money will come back for India dedicated funds. And it will not come in the emerging market basket, but it will come, say, an India focused fund. So you will find money coming back to India from FIs also, maybe not immediately, maybe after a few months, after more things settle down internationally. And this money will coming purely for India allocation, because within the whole emerging market, gradually it is becoming evident that India is the most stable economy from growth perspective, from demographics, from future potential, from industrial growth, also the top I would say, the prime minister who's continuing for last 8 years, visibility that, things will continue for the next 5 years. So these are things which is giving a lot of comfort in the whole emerging market basket, wherein you have conflicts in Russia, in China, different type of things happening. The consistency of policy is very, very high in a country like India. And that is, I would say, will attract money, but it will not happen immediately. It'll take some time. But till then, I think the domestic guys like us are always there to support the market.
Yeah, so domestic institutional players have been net positive for quite some time.
Yeah, I think the domestic investors, investors also on this call, I think, they have been big support for the market, wherein I think, the domestic retail, domestic HNI, everyone has been buying in the market.
Yeah, so that's how it is. Why did I ask this question particularly to you is because you as an organization have had history of dealing with these FIs for long period of time. Your promoters of the company have been involved in talking to them. So therefore, and then obviously you had your institutional research backing up this. So you get to know what's happening in FIs market. You have a clear cut understanding there. And when you interact with them, you get to know more about it. So
Absolutely.
yeah. See, so the last question before we conclude. So a lot of things have covered up. In fact, there are three questions which have come up now. So if you can take us through your team, so how is your team position? And some investors have shown interest to know more about your organization. So if you could just take us through that.
Sure. One, I'll just put up a slide which will kind of
Please.
give some visibility on the team.
Please.
So Quest as an entity, it's a very old entity, and which you must be aware about. That as an entity, Quest is a very old entity which had started way back in the 1980s, and from 1987 to 2007, we were mostly focused into equity research ideas. And 2007 is wherein we started our first PMS. And we can say, as of today, Quest is one of the older PMS houses in the country, which has a 14-year kind of a record. So as of today, if you talk to people, there are some 400 PMS managers in the street, but out of 400 PMS managers, very few of them can show a 14-year kind of a history, wherein you have a decent track record of 14 years. In last 14 and a half years, we would have seen everything. We would have seen the subprime crisis, the Greek crisis, ILFS crisis, pandemic, everything. Now, over this period, definitely, having around 17-18% annualized return over 14 and a half years is something which is really commendable. Talking about the team, company was founded by Mr. Ajay Seth and Mr. Bharat Seth, and they are a part of the investment committee, and they have a decent 30-40 years experience in the market. I'm there as a part of the investment team. I bring along with me around 15 years plus kind of an experience. Along with us, we have our head of research, Saurabh. He has joined us from HDFC Mutual Fund. So he has been with HDFC for almost 13 years. So the team has a very, very vast experience, having worked in different industries and different kind of the financial firms. Along with us, we have a team of 6 analysts, and we track around 180 to 200 companies. So you can say we have a 10-member team which manages all the investment decisions, research, analysis, financial models, engagements with companies, investment notes, etc., etc. So it's not like a one-man show that just managing the money at the whims and fancies of myself. So it's a proper investment committee with supported by investment the research team, which takes all the calls on the investment ideas.
Okay, great. So last two questions. So how do you see the stocks in EV sector? Do you possess any of that in your portfolio?
So EV as a sector, EV has a very small kind of opportunity right now, but I think there are many, I would say, opportunities which you can play around the EV. Now, if I say, I have a Tata Motors in my portfolio, which we spoke about. Now, I think in India, if you see, Tata Motors is practically the only option which you have for buying an electric car in the four-wheeler space. There's hardly anyone who has any models. And now I think in the next 18 months, you will find all the Tata cars coming in the EV option. So that is one thing. The other thing which we are playing is through Tata Power, because Tata Power is putting up the largest EV charging ecosystem in the country. They are putting up around 7,000 EV charging stations in the country across different states. That is the other way which we are playing it through. The third company which we have, which might not be a direct correlation to EV, but there are talks of things happening on that front, is the Tata Chemicals. Though we have bought Tata Chemicals for its soda ash business, but there is an option value that there were talks earlier of them putting up the lithium-ion battery in Gujarat with a 4,000 crore capex. Now, if and when that thing happens, I think it's going to be a good option value opportunity for the company. So these are different areas through which we are playing. As I mentioned that we have some ancillaries, auto ancillaries also, but they are agnostic to the engine. So they are agnostic to internal combustion engine or an EV engine.
Can you now that your presentation is there up and running, so if you could show us your performance of last 10 years or 14 years?
Sure. So this basically shows my earlier performance at IFL when I was managing the IFL multi-cap PMS. So this shows the returns for the period which I was managing it. So I had launched it in December of 14, and from December 14 to December of 19, it had given around 19% annualized return compared to a benchmark return of around 8% at Quest, we have the two strategies, which is Quest Multi and Quest Flagship. And Quest Flagship has a 14-year plus history. Over this 14-year, it has given us 17.5% return compared to a benchmark of around 8.8. Quest Multi also has a 7.5-year kind of a history. and that has also given like a 17% type of an annualized return. So you can see the last 2 years at Quest is where the return has to be compared, which is 5 years of IFL and the last 2 years of Quest. Over the 7 years, there has been like a 10% alpha over the benchmark annualized.
Okay.
So these are some of the names which we would have bought in the last 2 years. So
Yeah, so
in
more
the last 2
disclaimer
years,
here in Nirud, for the benefit of everyone. So all the participants, you are requested to please speak to your advisors before you invest in any of these companies. We would request you not to do so. Yeah, over to you.
yeah. So these are some of the names which you would have bought in our portfolios. And as mentioned by you, that these are not the recommendations. These are just to show that what we would have bought. Some of them we might have already exited, as mentioned in the exit price, and some of them we continue to hold because we are bullish with a much more long-term horizon.
Sure, understood. So no more question from our side. Thank you so much for taking the time out and joining in today, Anirudh. It was a great presentation and great interacting with you always.
It's always a pleasure.
All
Thank
right.
you.
Thank you, everyone. If you have any question, please write to me at vikas@aifpms.com. I'll ensure that we answer all your questions. Thank you.
Thank you.
Thank you.